Every investment comes with risk, but not every risk leads to a loss. The real question isn't is this investment risk-free? It's how are the risks identified, managed, and your capital protected? Whether it's understanding investment risks, how risks are identified and mitigated, how investor capital is protected, or the difference between investment risk and capital loss, knowing these fundamentals can help you invest with greater confidence and clarity. In this video, we'll break down the basics of risk management and investor protection in GHL India asset secured NCDs in a simple and practical way. Let's take a closer look. 1. What are the risks involved in this investment? Every investment involves a certain degree of risk, and secured NCDs backed by real estate are no exception. At GHL India Asset, we believe that an informed investor is a confident investor. Therefore, we openly communicate both the opportunities and the risks associated with the investment. Our objective is not to eliminate risk, but to identify, assess, mitigate, and manage it through a disciplined investment process. What types of risks exist? The principal risks include 1. Market risk. Real estate prices may fluctuate due to economic conditions, interest rate movements, demand and supply, government policies. These factors may influence the timing and value of property exits. 2. Liquidity risk. The secured NCDs issued by GHL are unlisted redeemable debentures. Accordingly, there is no exchange-based trading. There is no premature redemption facility. Investors should be prepared to remain invested until maturity. 3. Execution risk. Every real estate project involves execution risk, including property acquisition, legal documentation, development milestones, buyer identification, property monetization. Delays in any of these areas may affect project timelines. 4. Regulatory risk. Changes in land regulations, tax laws, development policies, government approvals may affect project execution or investment timelines. 5. Cash flow risk. The timing of property sales and cash inflows may differ from projections. This could temporarily affect project cash flows. 6. Default risk. If an issuer fails to meet its repayment obligations, investors may be exposed to default risk. To help mitigate this risk, GHL structures its investments with property-backed security, debenture trustee oversight, registered charge over the secured asset, project-specific SPVs. How does GHL manage these risks? Risk management begins before an investment is made. Our framework includes legal due diligence, technical due diligence, financial evaluation, market assessment, acquisition at disciplined valuations, project-specific SPV structure, asset-backed security, independent debenture trustee, continuous project monitoring. Does risk mean loss? Not necessarily. Risk refers to the possibility that actual outcomes may differ from expectation. A risk does not automatically result in a loss. The purpose of risk management is to reduce both the probability and the impact of adverse events. The 5 principles of risk management at GHL India Asset. Identify risks before investing. Mitigate risks through structure. Protect capital through security. Monitor risks throughout the investment tenure. Communicate transparently with investors. Important clarification. We do not promise a risk-free investment. We provide a structured framework for identifying, mitigating, and managing investment risks. Many investors evaluate only the return on investment. Professional investors evaluate the risks, the mitigation measures, and the protection mechanisms before making a decision. Every investment has risks. The important question isn't whether risk exists, it's how that risk is managed. At GHL India Asset, our focus is on disciplined diligence, asset-backed security, trustee oversight, and continuous risk monitoring. Risk is not the enemy of investing. Unidentified and unmanaged risk is. Successful investing is not about avoiding risk. It is about understanding and managing it intelligently. 2. Is this a risk-free investment? No, this is not a risk-free investment. Every investment, whether it is in fixed deposits, bonds, mutual funds, equities, real estate, or secured NCDs, carries some degree of risk. The nature and extent of those risks vary depending on the investment. At GHL India Asset, we believe that transparency builds trust. Rather than describing any investment as risk-free, we focus on identifying, assessing, mitigating, and continuously monitoring the risks associated with each investment. Our objective is to protect investor interests through a disciplined investment process and multiple layers of risk management. How does GHL reduce investment risk? Although no investment can eliminate risk completely, GHL adopts several measures to reduce potential risks, including comprehensive legal due diligence before property acquisition, technical and commercial evaluation of each property, acquisition at disciplined valuations, investment through project-specific SPVs, secured NCDs backed by identified immovable property, appointment of an independent debenture trustee, registration of charge over the secured assets in accordance with applicable laws, continuous monitoring of project progress and key risks throughout the investment tenure. These measures are intended to strengthen investor protection and promote disciplined risk management. Why don't we use the term risk-free? No responsible financial institution can guarantee that an investment is entirely free from risk. Factors such as market conditions, regulatory changes, economic developments, and unforeseen events may affect investment outcomes. By openly acknowledging these realities, we aim to help investors make informed decisions based on a balanced understanding of both the opportunities and the risks. What should investors focus on? Instead of asking whether an investment is risk-free, investors should consider what are the key risks, how have those risks been identified, what safeguards have been implemented to mitigate those risks, how are risks monitored throughout the investment period, what mechanisms exist to protect investor interests if challenges arise. These questions provide a more meaningful basis for evaluating an investment. Important clarification: prudent investing is not about finding a risk-free investment. It is about choosing an investment where risks are understood, disclosed, and managed responsibly. Some investors assume that fixed returns mean a risk-free investment. In reality, fixed returns and investment risk are separate concepts. Investors should always evaluate both the return potential and the underlying risk management framework. Is this investment risk-free? No, and no responsible investment company should claim that it is. The better question is, how are the risks managed? At GHL India Asset, our focus is on disciplined due diligence, secured structures, trustee oversight, and continuous risk monitoring. Every investment carries risk. What distinguishes a professionally managed investment is not the absence of risk, but the strength of its risk management framework and its commitment to transparent communication. Transparency about risk is not a weakness. It is the foundation of long-term investor trust. 3. How does GHL India Asset identify investment risks? At GHL India Asset, risk identification begins well before an investment is made. We believe that preventing risk is more effective than responding to it after it occurs. Every investment opportunity undergoes a structured due diligence process to identify potential legal, commercial, financial, technical, and market-related risks before funds are deployed. Our objective is to make informed investment decisions based on verified information rather than assumptions. What risks do we evaluate? Our due diligence framework includes an assessment of 1. Legal risk. We verify ownership and title of the property, encumbrances, mortgages, or other charges, pending litigation if any, compliance with applicable land laws, availability of required approvals and permissions. This helps reduce the risk of legal disputes affecting the investment. 2. Market risk. Before acquiring a property, we assess current market demand, supply conditions, future development potential, infrastructure growth, exit opportunities, expected absorption by buyers or developers. This helps us understand the property's commercial viability. 3. Financial risk. We evaluate acquisition cost, estimated project expenses, expected sale proceeds, cash flow requirements, debt servicing capability, project profitability. This helps determine whether the investment is financially sustainable. 4. Technical risk. Our assessment includes physical characteristics of the property, site accessibility, development feasibility, utility availability, environmental or physical constraints. These factors influence the practicality and value of the investment. 5. Regulatory risk. We monitor applicable laws and regulations, including land use and zoning, development control regulations, approval requirements, changes in government policies that may affect project execution. How does GHL conduct risk identification? Our process includes collection and verification of relevant documents, independent legal due diligence, market and location analysis, financial feasibility assessment, internal investment evaluation, investment committee review before approval. Only investments that satisfy our internal evaluation criteria proceed further. Is risk identification a one-time exercise? No. Risk identification continues throughout the investment lifecycle. As market conditions, regulations, and project status evolve, we regularly review potential risks and take appropriate actions where necessary. GHL's 5-step investment risk assessment framework. 1. Legal due diligence. Verify ownership, title, and approvals. 2. Market assessment. Evaluate demand, growth potential, and exit opportunities. 3. Financial analysis. Assess project viability and cash flows. 4. Technical evaluation. Review site conditions and development feasibility. 5. Investment committee approval. Final review before investment. Important clarification. At GHL India Asset, risk management starts before the investment is made and continues until the investment is successfully completed. Some investors focus only on the purchase price of a property. Professional investment decisions require a comprehensive evaluation of legal, commercial, financial, technical, and regulatory risk before committing capital. Successful investing starts long before money is invested. At GHL India Asset, every property undergoes legal, financial, technical, market, and regulatory due diligence. We believe that identifying risk early is the first step toward protecting investor interests. The most effective way to manage risk is to identify it before it becomes a problem. The quality of an investment is determined not only by the asset we acquire, but also by the discipline with which we evaluate it before investing. 4. How does GHL India Asset mitigate investment risks? At GHL India Asset, identifying risks is only the first step. Our focus is on implementing appropriate measures to reduce the likelihood and impact of those risks throughout the investment lifecycle. We follow a structured risk mitigation framework that combines thorough due diligence, disciplined investment practices, asset-backed security, independent oversight, and continuous monitoring. While no investment can eliminate all risks, our objective is to manage them responsibly and protect investor interests. Our risk mitigation framework. 1. Comprehensive due diligence. Before acquiring any property, we conduct detailed legal due diligence, technical due diligence, financial evaluation, market cycle analysis, PSTIL analysis. This helps identify potential risks before any investment decision is made. 2. Disciplined property selection. We invest only after evaluating factors such as location potential, future infrastructure development, market demand, exit opportunities, commercial viability. This helps us select properties that align with our investment strategy. 3. Project-specific SPV structure. Each investment is undertaken through a dedicated special purpose vehicle, SPV. This structure helps ring-fence project-specific risks, maintain clear financial accountability, isolate liabilities between projects. 4. Asset-backed security. The secured NCDs are backed by identified immovable property. This provides a layer of security for investors and strengthens the overall investment structure. 5. Independent debenture trustee. An independent debenture trustee is appointed to act in accordance with the trust deed and applicable laws. The trustee oversees the security created in favor of the debenture holders and acts in their interests in accordance with the agreed terms. 6. Registration of charge. A charge is created over the secured asset and registered in accordance with applicable legal requirements. This strengthens the enforceability of the security interest available to the debenture holders. 7. Continuous monitoring. Risk management does not end after the investment is made. Throughout the investment tenure, we monitor project progress, legal developments, market conditions, regulatory changes, cash flow performance. This enables timely identification and management of emerging risks. Is risk mitigation a continuous process? Yes. Risk mitigation is an ongoing process that begins before acquisition and continues until the investment is successfully concluded. As circumstances evolve, we review potential risks and take appropriate actions to manage them. The GHL Multi-Layer Risk Mitigation Framework. Investment opportunity, comprehensive due diligence, PSTIL and market cycle analysis, investment committee approval, project-specific SPV, independent debenture trustee, secured asset registered charge, continuous monitoring until maturity. Important clarification. At GHL India Asset, risk management is not a one-time activity. It is a continuous process embedded in every stage of the investment life cycle. Some investors believe that security alone eliminates investment risk. In reality, effective risk mitigation combines careful asset selection, sound legal structuring, disciplined governance, and ongoing monitoring. Risk management isn't about reacting to problems, it's about preventing them. At GHL India Asset, we combine due diligence, PSTIL analysis, market cycle analysis, project-specific SPVs, secured assets, trustee oversight, and continuous monitoring to manage investment risks responsibly. Effective risk mitigation is built on prevention, preparation, and continuous oversight, not on assumptions. The strongest protection for an investor is not a single safeguard, but multiple layers of disciplined risk management working together. 5. How is investor capital protected? Protecting investor capital is a key consideration in the way GHL India Asset structures its investment offerings. While no investment can guarantee complete protection against every possible risk, we implement multiple safeguards designed to strengthen investor protection and support disciplined risk management. Our investment structure combines careful asset selection, legal documentation, secured assets, independent oversight, and continuous monitoring to help safeguard investor interests. How does GHL strengthen investor protection? 1. Investment in identified real estate assets. The funds raised are deployed into identified real estate projects that are evaluated through comprehensive legal, financial, technical, and commercial due diligence before investment. 2. Secured NCD structure. The investment is made through secured non-convertible debentures, secured NCDs. The security is created over identified immovable property in accordance with the terms of the trust deed and applicable laws. 3. Project-specific SPV structure. Each project is executed through a dedicated special purpose vehicle, SPV. This structure helps ring-fence project-specific risks, maintain separate financial records, prevent liabilities of one project from affecting another. 4. Independent debenture trustee. An independent debenture trustee is appointed to oversee the security created for the benefit of the debenture holders. The trustee performs its responsibilities in accordance with the trust deed and applicable legal provisions. 5. Registered charge over the secured asset. A charge is created over the secured property and registered in accordance with applicable legal requirements. This strengthens the legal framework supporting the security provided to debenture holders. 6. Continuous monitoring. Investor protection does not end after funds are deployed. We continuously monitor project progress, legal compliance, market developments, cash flow performance, risk indicators. This enables timely identification and management of emerging issues. Does this mean capital protection is guaranteed? No. No investment should be presented as carrying a guaranteed return or guaranteed protection unless such a guarantee is legally valid and expressly provided. Our focus is on implementing a robust investment structure and multiple layers of safeguards designed to reduce risk and protect investor interests. However, like all investments, secured NCDs remain subject to investment and business risks. Why are multiple safeguards important? Professional investors do not rely on a single protection mechanism. Instead, they evaluate the overall investment framework, including quality of the underlying asset, legal documentation, security structure, governance, independent oversight, ongoing monitoring. The combination of these measures contributes to a stronger risk management framework. The GHL Capital Protection Framework. 1. Rigorous due diligence. Evaluate legal, financial, technical, and market aspects. 2. Quality asset selection. Invest in identified real estate opportunities aligned with GHL strategy. 3. Project-specific SPVs. Isolate project risks and maintain accountability. 4. Secured NCD structure. Create security over identified immovable property. 5. Independent debenture trustee. Oversee the security in accordance with the trust deed. 6. Registered charge. Strengthen the legal framework supporting the security. 7. Continuous monitoring. Monitor projects, risks, and compliance until maturity. Important clarification. Investor protection is achieved through disciplined structuring, prudent governance, and continuous oversight, not through promises or assumptions. Some investors assume that a secured investment means there is no risk. In reality, security is an important safeguard, but it is one element of a broader risk management framework that also includes governance, due diligence, legal documentation, and ongoing oversight. How is your capital protected? At GHL India Asset, we use multiple layers of protection: identified real estate assets, secured NCDs, project-specific SPVs, an independent debenture trustee, registered security, and continuous monitoring. Investor protection is built through structure, not promises. Investor protection is not based on a single safeguard. It is the result of multiple, well-designed measures working together to support responsible investment management. Capital protection begins with disciplined investment decisions and is strengthened through sound legal structure, independent oversight, and responsible risk management. 6. What is the difference between investment risk and capital loss? Many investors use the terms investment risk and capital loss interchangeably. However, they have different meanings. Understanding this distinction helps investors make informed decisions and evaluate investments more objectively. At GHL India Asset, we believe that every investor should understand not only the potential returns of an investment, but also the nature of the associated risks. What is investment risk? Investment risk is the possibility that actual outcomes may differ from expectations. It refers to uncertainty arising from factors such as market conditions, regulatory changes, economic developments, project execution timelines, cash flow variations, property sale timelines. The presence of risk does not necessarily mean that an investor will incur a loss. What is capital loss? Capital loss occurs when an investor is unable to recover all or part of the principal amount invested. A capital loss may arise due to circumstances such as significant deterioration in the value of the underlying asset, failure of the investment to generate sufficient proceeds, serious legal or operational issues affecting the investment, other adverse events impacting repayment. Capital loss is therefore one possible consequence of investment risk, not the definition of risk itself. Possible outcomes of an investment: 1. Positive outcome, investment objectives achieved. 2. Neutral outcome, delays or variations managed effectively. 3. Adverse outcome, if significant risks materialize despite safeguards, investors may face losses. How does GHL seek to reduce the risk of capital loss? GHL implements several measures designed to strengthen investor protection, including comprehensive legal, technical, financial, and commercial due diligence, disciplined property selection, project-specific SPV structure, security over identified immovable property, independent debenture trustee, registration of charge over the secured assets, continuous monitoring throughout the investment lifecycle. These measures are intended to reduce the likelihood and impact of adverse events. However, they should not be interpreted as eliminating all investment risk. Why is this distinction important? Professional investors understand that risk is a possibility. Capital loss is an outcome that may occur if risks materialize and cannot be effectively managed. The objective of a disciplined investment framework is to identify, mitigate, and manage risks so that the probability of capital loss is reduced. Important clarification. Risk is part of every investment. The goal of professional investment management is to minimize the likelihood and impact of risks, not to claim they do not exist. Many investors avoid any investment described as risky without understanding the nature of the risk or the safeguards in place. The key is to assess how risks are identified, mitigated, and managed, not simply whether they exist. Risk and capital loss are not the same. Risk is the possibility that outcomes may vary from expectations. Capital loss is the actual loss of your investment. At GHL India Asset, our focus is on identifying and managing risks to reduce the likelihood of capital loss. Investment risk is the possibility of uncertainty. Capital loss is a potential consequence if those risks materialize. Understanding the difference helps investors evaluate opportunities with greater clarity and confidence. Successful investing is not about avoiding every risk. It is about managing risk so that the possibility of capital loss is responsibly reduced. Every investment faces challenges. What matters is how those challenges are managed. In the next episode, we'll cover the intermediate level of risk management in investor protection, where we'll explore real-world scenarios such as falling property values, delayed property sales, the risk-reducing role of SPVs, debenture trustee oversight during financial stress, and how risks are continuously monitored throughout your investment journey. More clarity, better decisions. Join us in the next episode.